Okay, we are here with Melissa DEllena. She is the best real estate attorney in the state of Rhode Island. Are you licensed anywhere else?
Massachusetts.
Massachusetts.
Pretty soon
well.
Connecticut.
Oh, nice. Yeah, that's where we gotta go.
Yeah.
So, we're here to talk about seller financing. It's something that I feel like every seller should know, that you can make money even after you sell your house. So just like the bank does, you're able to make 5.5, 6, 7, whatever percent you decide, you can become the bank. So even after you sell your property, you'll still be making an income for however long you want
whatever the term of years are that are decided. So seller held financing is becoming more increasingly popular right now as a function of the interest rates raising and with people having struggles with getting loans. If they have any kind of derogatory credit impacts. Recently had one where the client didn't qualify for financing because they weren't in a 40-hour-a-week job. They worked 40 hours, but that wasn't quite the 40 hours that the bank needed to qualify it. So seller-held financing is typically when two parties are under contract. Seller is going to sell the house to the buyer, but the buyer cannot secure financing independently, and the seller will agree to let them borrow the money in order to purchase the property.
But I also feel like that's kind of like a misconception in the fact that, like, I guess anyone could do seller financing. Like, if I had 20% down and I still could get a mortgage, like, wouldn't you offer? I would offer that as a buyer to the seller.
So you're saying they can't get financing, maybe is the misnomer. You could get financing, but seller financing might be more attractive. The difficulty is you have to have the right seller. So although it is a nice idea because you can generate some income, if you need all of your proceeds in order to buy something else, you're not the right candidate for seller held financing, because in that case you need your proceeds. And one other definite no-no, there cannot be a mortgage on the property already.
So you have to be a seller that owns their property outright. There can't be a mortgage on it, second lien, anything.
No.
And that's the only way you could even become the bank and do the seller financing.
Right.
So what were you saying?
So some of the advantages of the seller held financing is usually reserved for people who are unable to secure traditional financing, because oftentimes seller held financing would be at a higher premium as far as the interest rate, not market rate, unless it's family, which we do also have a fair number of transactions that are familial. Mom or dad will buy the property and then they'll create financing for the children to purchase it from them.
Oh, that's smart.
Yeah. They'll hold the paper.
I mean, I'm always, like, as a buyer, we're buying in Vermont. So I'm always, and it's a second home, it's a second home. But for most of the people in that Vermont area, it's also a second home for them too.
Sure. Yeah.
So I'm like, if you don't need $500,000 tomorrow, like up front in a month, why not I'll give you my 20% down that I have, or 15% down.
Yeah.
I know my second home loans are like at 8.5%.
Yeah, they're
so if I could, so that's why I feel like I'm like, if I could get a seller to agree to seller financing, even at like 6%, I could save like 2.5 points. And I think that we're giving 15-20% down, but we already have the approval from the bank. So I mean, wouldn't it be the easiest thing to just take it on?
I mean, easy, yes. There are certain risks for the seller, because in the event of a buyer default, if they were not going to keep up with those monthly payments, now the seller would have to foreclose, because presumably you would paper the file, right? There would be a promissory note, a mortgage, and a whole host of other types of loan documents. You also have to deal with tax liabilities associated with earning that interest over the term of years. So it's not super straightforward and simple for a seller. It's probably far easier for them just to sell the property and walk away. I think as a seller,
my thing though, right, is like, okay, my thing is like, okay, if you do a 30-year loan, and that was something that we were talking about.
Yeah, the terms.
How do you say the
amortization?
That's the thing. So you have this graph, right? When you go to buy a house, when you go and sit down with Melissa to buy your house, they give you the schedule, essentially, like what you're going to pay for the next 30 years. You look at the bottom line for how much, so you buy the house for $500,000. At the end of it, even if you're paying like 3.5%, even our house, it's double, right? So you're paying $1 million and a little bit more, actually, for the house. So for me, I'm like, if I were a seller and I could sell this property, take $100,000, as a I don't need more than that, and be able to finance the rest. And then even though I'm old, you know, when I die, now my kids can continue to get that. Where else are you making $500,000?
Right. I mean, I guess there's lots of strategies to employ. If you take that lump sum and you put it into annuities or other market opportunities, maybe you can make the same amount. Maybe the risks are higher, though, in order to make the same amount. So I think it really is important that if a seller is entertaining the idea of seller held financing, that they're talking to a financial advisor as well as an attorney about what is the best option for them.
Right.
Because I do think that there's a lot of buyers who are open to it, and they are usually willing to pay market rate. So you're talking about it from there's being a savings, but I'm saying if I represent the seller, they bear the risk. So I'm not going to give you seller held financing for under market rate. I want market rate because I want to make sure that I'm getting paid at the same rate you would be paying the bank.
Right. But a lot of people don't know that, like, you know,
the market rate's 8.5
for a second home, you know, depending on
and the rates can't be usury if people are going to be living there. So, you know, you might be thinking usury is the legal word of basically, you know, taking advantage. So the courts won't allow for me to take a 14% interest rate on someone who's going to live there because that's not reasonable. You know, the highest interest rate you would see is maybe 7, 8. In some instances, this time of market, we've seen it like higher, but only if you have, you know, again, very difficult credit and it's a particular type of loan where that's all you can be eligible for.
Yeah. So, I mean, I feel like if
you can't set your own rate. Can't be whatever you want.
Oh, you can't be like 25.
No, because that's usury.
Yeah.
So
you're using them.
You're using them. I'd say anything over 12 to 14, you're really in a place. You know, really anything, it's hard money. It's really reserved for commercial, private financing, nothing for a primary resident. I'd say if you're getting to the point of 10 or higher, you're probably dangerously close to usury. So it should be in line with market.
Yeah, so don't be a jerk.
Keep it real.
Keep it, just like, you know, just everyone's happy making a little bit more money while versus the bank. So if I were a seller and you were to look at like the best case scenario, you would want someone who maybe already is pre-approved. And I do actually have a loan officer who will pre-approve you. He's like, I don't even care. He's like, you know, send me the refi.
Right. Yeah. Well, I mean, the end goal is not to be in that loan program for a 30-year period.
But why not?
Well, because typically people need the money eventually. So it would normally be a 30-year amortization with a 5-year balloon is one of the most popular features that we see. So at the end of 5 years or 60 months, you're expected to be refinancing that loan into a traditional mortgage unless you have something that you're going to sell and pay off this mortgage so that that person can recoup their funds.
But you don't have to.
So like, it depends. It can be structured on however the parties want to structure the terms can be drafted.
Right. So like, I mean, you could even do like a year, 1 year balloon. So a balloon is like, hey, we loaned you $500,000. You know, whatever you pay down in the year, now you owe that like $400 and probably like $90,000.
And it's all referenced on the amortization schedule, so you can see exactly what your payment balance will be at the end of that balloon period.
Yeah. So you could do 1 year, you could do 5 years, you could do 10 years, you could do 30 years, you could do 35 years. You know, depending on what you want. You're like, do I need that $500,000? Like, would I like that in a year? Would I like that in 5 years? Do I not even need it because I'm wealthy enough to not need it?
I mean, change of circumstances can happen to anybody. And you mentioned, you know, in the event of a death, you would want to make certain that there's joint tenants, someone that would survive you. Otherwise, that asset has to run through probate. I think that it's better to have a shorter term balloon period with the expectation that you could always extend it. Because if you did 5 year with extended 5 year periods, then you can make the decision, do you want to get to 10?
Do I want to cash out or not?
Right.
Yeah. I just had this one seller, he owned like 150 units. We went to go see this like amazing house, which we couldn't have gotten in because it was like $800,000. I was like, it's a little bit above like what we're trying to do right now. So, but we couldn't get in, but we were like, we have the money. So he offered us, I mean, he had already offered us seller financing at like 5.5%. He's like, I don't care. You could do it for 30 years, 35 years. And my mom's like, what do you mean? Why would you do that? Like, why? This doesn't make any sense. I'm like, the guy's rich. He doesn't need the money. So, like, why not?
Because he's looking at it as an investment perspective, right? 5.5% over a term of years is going to be a better and more protected return on an investment than going into, you know, the stock market.
Just diversify it.
Yeah.
You know, so what else? So what else were we going to talk about? So, I mean, if I were a seller, yes, there's risks. This is why you have an attorney. I'm like, don't scare everyone.
I'm not scaring anybody. My feeling is you've got to be educated, eyes wide
Right.
open. You know, what are the risks? What are the returns? How are these options going to look? And how can we structure it? Most important is making sure that you have the terms negotiated between the parties and that then it's finalized with legal documents.
But then also understanding the joint tenancy, that whole legal process as well.
All things we would discuss.
Yeah. So I feel like if I were a seller, if I don't need all the money up front, if I just want $100,000, I would recommend getting anywhere from 15 to 20%. 20% being like the real number that we want.
Oh,
here.
You definitely need to have some
Absolutely.
money in the game.
And then reach out to me. I can connect you with a loan officer who will pre-approve, get you a pre-approval so that you're not doing it on your own.
Yeah, it's really difficult for the average person to vet. So
Okay.
I think having
Who
that
would wanna do
resource is
that?
so helpful.
Yeah.
You really can't. I mean, you don't
shouldn't.
have the ability to vet somebody the way a loan officer would.
Yeah, so like why not do that? So I don't know. I think it's a really great opportunity for sellers to kind of think about how to diversify their investments, how to make a return on their investment, you know, and be able to really create generational wealth, because even after your death, then your kids are getting paid whatever that monthly payment would be. Which would be awesome.
Yeah.
You know, I mean, how much would that even be? Probably like $3,500 a month, if not more.
And you don't have the carrying costs that are associated with holding the real estate. You know,
Right,
because
you
I'm sure
don't
people are
have to
like,
fix the
well,
roof.
why not just hold the real estate? Well, you could, and you'd be facing the appreciation, but presumably you have tenants, and now you have to deal with management fees, carrying costs, you know, like you said, obligations of maintenance.
But it also, like on the tax side, you know, you're looking at, in real estate, once it's fully depreciated, it's time to move your money somewhere else, right? So you're not getting any of those depreciation benefits.
And you really aren't with the seller held financing either, because all you're doing at that point is realizing a stream of income.
That's what I'm saying. So why not sell it and then continue to make the money? So, and then this is something else I heard, but I don't know if it's true. So on second homes, apparently there's like a higher capital gains. There are
for the sale?
Yes, there are tax benefits, because I know anything under $250,000 like won't get taxed once you're above that. So once you're above that, then you're gonna get taxed at like a huge percentage. So
I don't get in the realm of determining tax numbers.
No, she's not in it. She's not in the
Talk to your accountant.
But what I'm saying is, why not get that under $250,000, right, where you're not going to get taxed? So you have that 20% up front. And then over the length of time, you're not going to get hit with that full amount of taxes in the front. So
it's difficult because that $250,000 exclusion is only on the sale of a primary residence anyway. So it really depends if a seller was using that property for investment or a primary or a secondary. So I think, you know, we've already said, talk to an attorney, talk to an accountant, talk to a financial advisor. That will get you covered to a place where then you can make an informed decision.
Right. So if you guys are interested in learning a little bit more about seller financing, and talking with us about creating generational wealth, as well as making some money on your money, that'd be great.
Money to work.
Yeah. So this is Melissa DEllena and Megma with Century 21. We'll talk to you soon. Bye. Okay.